headlines say property investing in Australia is dead. The recent budget completely overhauled the rules, axing negative gearing on established homes and scraping the 50% CGT discount starting July 1st, 2027. But here's what the mainstream media isn't telling you. Every time the government builds a wall around the tax system, they accidentally leave a few massive doors wide open. If you know how to read the fine print of this budget, there are loopholes, grandfathering clauses, and structural workarounds. That means smart investors aren't just going to survive this, they're going to thrive. And in this video, we're going to break down the top 4 property tax hacks you can use right now to navigate the rules. If you want to protect your portfolio, hit the subscribe button and let's dive in. So let's start with the absolute biggest loophole to emerge from the Treasury's guidelines. And it's a goldmine for anyone who already owns a home. The budget stated that existing properties are grandfathered to protect past investment decisions. But Treasury recently confirmed that this grandfathering also applies to properties that were owner-occupied on budget night as well. So what does this mean for you? If you own a home right now that you bought before May 2026, you can live in it for the next few years. Down the track, you can buy a new home to move into and convert your old home into a rental property and fully negatively gear it against your salary, even deep into the 2030s. This creates a massive unfair advantage for existing homeowners over first-time investors. If you're thinking about selling your current home to upgrade, don't. Keep it, turn it into a rental, and unlock a grandfathered tax shield. But what if you want to buy an established property after the cut-off date? Well, the media says negative gearing is completely gone, and technically that is correct. The new rules state that losses on new purchases are quarantined, meaning you can't use them to lower your tax you pay on your 9 to 5 salary wage, but you can still use those losses to offset income from other residential properties. So if you already have a couple of properties generating positive cash flow, you can buy a high growth, negatively geared property and use its losses to completely wipe out the tax bill on your cash flowing assets. And what if you don't have other rental income? The loss isn't completely lost here. It actually gets rolled forward into the property's cost base. So when you eventually sell the asset years down the line, all those years of accumulated losses are deducted from your capital gains, saving you a fortune on the exit. It's not an avoided deduction, it's just a delayed one. Now I want to talk about capital gains tax. The budget swapped the old 50% discounts for an inflation indexation model and slapped a minimum 30% tax floor on capital gains. But guess who got a free pass here? Self-managed super funds. The legislation explicitly excludes super funds from these CGT changes. If you buy an investment property through a properly structured SMSF, you completely bypass a 30% minimum floor. Even better, if you hold that property in your super fund until you retire and move your fund into a pension phase, your capital gains tax rate drops to a beautiful 0%. Experts are already predicting a massive wave of capital shifting out of personal names and into SMSFs for exactly this reason. You only need a starting balance of around $300,000 to $400,000 to make an SMSF a viable property vehicle. Now, our final strategy is simply playing the game exactly how the government wants you to play it, because they left massive incentives on the field. So negative gearing remains 100% legal and unchanged for new builds. If you build a brand new house or buy a newly completed apartment, you get the full immediate tax deductions against your wage, just like the good old days. Furthermore, the negative gearing bans only apply to residential property, meaning commercial real estate like warehouses, offices, real estate spaces is completely untouched. Commercial property already offers much higher rental yields, and now it retains superior tax advantages over traditional established housing. So look, the game has changed, but the goal remains exactly the same: build long-term wealth. Property leverage is still the most powerful tool in Australia for financial freedom. You just need to adjust your playbook. Now, before you make any moves, make sure you sit down with a property-savvy accountant or strategist to see how these exact clauses apply to your specific income and goals. So, which of these hacks are you looking at using? Drop a comment below, give this video a like if it cleared up the confusion, and I'll see you in the next video.